The wealth of our middle class has been ripped from their homes.
Korea's middle class saw its lowest income growth rate on record last year.
In the middle class today are trying desperately to survive.
The middle class is getting squeezed. Rising costs from groceries to housing are outpacing wages and leaving many households stretched very thin.
For many people, it feels harder than ever to get ahead. Housing costs exploded. Savings don't stretch as far. Even good incomes don't feel as secure as they once did. And building wealth, the kind that creates financial stability, feels increasingly out of reach. In 1971, 61% of American adults lived in middle-income households. By 2019, that share had dropped to 51%. The middle class didn't disappear overnight, but it's been shrinking steadily for decades. So, what actually changed? Most people point to inflation, expensive cities, weak wage growth, or bad policy decisions. Those factors matter, but the bigger story is structural. Over time, modern economies started rewarding ownership more than income. The people who owned assets, homes, stocks, businesses, saw their wealth grow faster than the people earning salaries. This wasn't random, it was the result of how the financial system evolved, and understanding that evolution explains why the middle class has been under pressure for decades. The core dynamic is simple. Wages grew slowly. Asset prices grew rapidly. From 1970 to 2018, median middle-class income rose by 49%. But upper-income households saw incomes rise by 64%. The gap widened. Wealth tells the bigger picture. In 1983, middle-income families held 32% of the country's total wealth. By 2016, that share had been cut nearly in half, down to just 17%. Meanwhile, upper-income families increased their share from 60% to 79%. What happened? Asset prices surged. Stocks, real estate, and business equity all appreciated rapidly. The people who owned those assets became wealthier. The people who earned wages without significant asset ownership fell behind. The system rewarded ownership more than income. One of the biggest drivers was cheap money. Interest rates fell for decades. Central banks lowered borrowing costs to stimulate growth. That flooded the financial system with liquidity, and it flowed into assets. Lower rates made borrowing cheaper. Investors took out loans to buy stocks and real estate. Asset prices rose as more money chased the same supply. As we explored in Why Houses Became So Expensive, cheap money doesn't flow evenly. It hits financial markets first, pushing up prices for housing and equities before it reaches wages. The middle class, which holds most wealth in home equity, did benefit when housing prices rose. But rising home values made it harder for the next generation to buy in. When asset prices rise faster than incomes, the gap between those who own and those who don't widens. Even when incomes rise, purchasing power doesn't always keep pace. Housing, childcare, education, healthcare, these costs have grown faster than wages. A larger share of income now goes to essentials, leaving less for savings. In 1970, median housing costs consumed about 20% of median income. Today, in many cities, that exceeds 30 or even 40%. Education costs surged. Healthcare became more expensive. Childcare rivals the cost of rent in many regions. As we discussed in Why Your Money is Worth Less, inflation erodes purchasing power over time. But the costs that hit middle-class families hardest, housing, education, healthcare, have risen the most. This created a structural squeeze. To maintain living standards, middle-class families took on more debt. Between 2001 and 2007, debt-to-income ratios rose from 100% to 157%. When the 2008 crisis hit, the middle class was heavily leveraged and concentrated in housing. Home values plummeted. Median wealth collapsed by 44%, nearly double the drop in housing prices. Why? Middle-class wealth was tied to homes financed with debt. When asset prices fell, net worth cratered. Wealthier households with diversified portfolios of stocks and business equity recovered faster. The gap widened further. This isn't unique to one country. The era of low interest rates was global. After 2008, central banks worldwide slashed rates and injected liquidity. That money flowed into assets everywhere. Globalization increased competition for middle-income jobs. Manufacturing moved to lower-cost regions. Automation replaced routine tasks. Urban concentration pushed housing costs higher in major cities where economic opportunities clustered. The result? Middle-class pressure became a global phenomenon. This is a structural outcome of how modern financial systems operate. Step back, and the pattern becomes clear. As we've explored in Why Every Country Keeps Borrowing More Money and Why Governments Need Inflation, modern economies are built on credit expansion, low interest rates, and asset appreciation. That system encourages borrowing and inflates asset prices, but it doesn't equally reward wages. Labor doesn't appreciate the way assets do. The middle class, built on wages and modest asset ownership, found itself caught. Incomes rose, but not fast enough. Housing became wealth, but also a barrier. Savings lost value to inflation. Debt became necessary. Modern economies increasingly reward ownership, leverage, and assets, more than labor alone. And the people who understood that dynamic early benefited the most. The middle class didn't suddenly disappear. The rules of the system slowly changed around it. Cheap money inflated assets, wages lagged behind. Essential costs rose faster than incomes, and the gap between those who owned and those who didn't widened steadily. The middle class didn't weaken because people stopped working hard. It weakened because the modern economy rewards ownership more than income. At the end of the day, the people who understood those changes early ultimately benefited the most.